And as for those of you staying in the plenary, in 2021, African tech startups raised $4.2 billion, which was more than what was raised in the years 2018, 19, and 2020 combined. So we see more mega deals being made, and fintech is taking over 60% of this pie. So this panel is looking at investing in African fintech. We are getting our participants and speakers mic'd up. And Dario Giuliani, while he's getting ready, will be facilitating this panel. He really doesn't need an introduction, but he's the director and the founder of Briter Bridges, who is the #1 ecosystem in information for investors. Is everybody good? Are you having a good time? Good. And just looking ahead, after this panel, we will have conversations on diaspora banking and remittances. And in the other breakout room, a conversation on cryptocurrency and how it's redefining the meaning of money. All right. Please welcome Dario for this panel. Thank you. You feeling lonely there?
I do.
A bit lonely.
I do. Shall I sing a song? Thank you for your patience. Just one more minute. Okay.
investing in African fintech.
We wait for someone in the back? No? We're good?
Yeah.
Cool. Thank you, everyone. Actually, these microphones are surprisingly very stiff to insert in your jeans. So apologies for the delay. It's good that we're all here. Myself, I'm Dario. I run a company called Briter. I am very happy to be here. I haven't seen some of these faces in years, some at all. So it's good to meet. The panel is about investing in fintech, and we're going to look at the space from an investor's perspective, but also from an opportunity perspective, and we'll try to be as critical and as objective as we can. We have a panel that sees 3 women fund managers across the continent, and Rob, who I haven't seen in, I think since the very early days, he's a veteran of the investment space on the continent. I'll let Nichole start introducing herself, and then we can go from this side.
Awesome. Good morning. My name is Nichole Yembra. I'm the founder and managing director for the Chrysalis company. So we have 2 sides of our business. One is Chrysalis Capital, which invests in early stage startups, and then Chrysalis Advisors, which helps build and structure really, really amazing companies. Our goal is to, again, work with them from early stage on as they get bigger. So some of the companies that we have worked with from one stage to another include Flutterwave and Helium Health, Bamboo, AutoCheck, all kinds of really fun people, and PiggyVest, of course. Odin should be here somewhere, so I have to say that. But thank you, great to be here.
Hi everyone, my name is Eunice Ajim, and I'm the founding partner of Ajim Capital. We are an early stage VC fund investing across sub-Saharan Africa. I think a little bit of my background, I'm originally from Cameroon, and my path to VC has been an interesting path from coming to the US as an international student to working in corporate America to co-founding 2 tech companies, and then just deciding that I wanted to pursue my passion to help the continent. And the tech startup ecosystem and the VC ecosystem was definitely the right path for me. So hence, we launched Ajim Capital about 6 months ago.
Hi everyone, my name is Barbara Iyayi. I'm the founding managing partner of Unicorn Growth Capital. We are a VC fund focused on investing in fintech and DeFi infrastructure companies and platforms just driving embedded finance. So our goal is really around building a synergistic portfolio of companies that are transforming financial infrastructure for the digital economy. My background for the last 16 years has been everything from investment banking, private equity, working in a technology company, and venture capital. But throughout the last 7 years, I've been very focused on financial services and fintech in general, and DeFi is just an extension of that.
Hi everyone, thanks for joining us. It's been so exciting catching up with old friends that I've almost left my voice outside the auditorium. But it's great to have you here today. My name is Rob Eloff. I'm a managing partner and co-founder of Lateral Capital. We got started investing in the African startup scene back in 2018. We've backed 23 companies across Africa. We predominantly invest in fintech and climate companies. And we've just recently launched our second fund to double down and do more of the same. And looking forward to getting the discussion started.
Fabulous. So thank you. So to get into the conversation already, something that excites me about this panel is that we've got different generations of investors. We could say Rob has been in the game for a while, raising second fund. We've got Nichole, who's invested in companies like Ilium, that we could say is not the latest generation of the success stories, but probably just before. We have new investors setting up new funds. And so last year, we've, according to the different sources, we've observed about $5 billion being invested on the continent. This refers to venture money that has gone into the digital and green space, and money that has been disclosed. As you know, a lot of the flows are don't necessarily come to the surface. So this is at the bare minimum, the money that has been raised. And we've seen that this amount of money, despite COVID, actually exceeds a lot of the flows that have happened across the continent over the past half decade. Now, first question to kick the conversation off is, what do you think the drivers have been of an increase in the perception of investment readiness for the continent, right? With, from the mid-2010s all the way now, what are the drivers? Is it a change in perception? Is it an actual structuring of more funds? Who wants to pick this up? I probably want to start with the new funds, maybe Eunice, or like Barbara,
Sure.
What is that is getting you excited about Africa today?
So I'm sure everyone's going to jump in, but I think there are a couple of things that have propelled this space to be kind of crazy right now. I think one, post-COVID, we definitely saw a lot of money coming into startups, because startups were doing better, right? They were just becoming, the case of digital transformation was proven post-COVID. And there's a lot of transaction activity, so a lot of startups could show that growth. And everyone talks about COVID growth, but that COVID growth led to a lot of capital coming in. So I think that's one. Two, I think just in general, there's just a lot more money in the ecosystem globally. So everyone is looking for areas that are just underpenetrated, and Africa is this place that most people just don't understand. And so to the extent that startups are actually showing growth and showing opportunity, there's a lot more money coming in. And so new funds are being set up because new LPs are looking at Africa and they're saying, hey, your new fund will give you money because you're in Africa. So I think it's just a mixture of that sort of perfect storm around COVID, around just global capital being very big, and all of that is making this ecosystem much more capital flourished. And we can talk about whether that's a good thing or not, but I think that's key drivers. Maybe you guys can add.
Yeah, I think just kind of putting things in context, yes, we raised $4 or $5 billion last year, depending on what numbers you want to look at, but that is still, less than 1% of global VC funding at $600 billion. I think this year it's expected that LATAM will do $15 billion, in Southeast Asia 25. And so, Africa at 10% of global emerging markets ex-China, I don't think that that's unrealistic in any way. I think as Barbara pointed out, something that we refer to internally, and I think the quote's attributed to Bill Gurley, is that in many ways with COVID, geography is dead for a lot of investors. And what I think we've just seen is a lot of friction being taken out of the system. I remember a time when, someone was traveling to a tech ecosystem on the continent, and 3 other people would ask them to meet founders on their behalf, which sounds so crazy right now. But I think this is all a good thing. And, we're on a global stage and we have the ability to play. So I'll leave it at that.
I mean, I'll probably double down on that by saying that if you look at the data, like a large proportion of this 5 billion actually goes to the top 25 companies. Okay, yeah. So let's say we've got 700-800 deals that were disclosed last year, and 20 companies out of this capture, what's that, 3-4% capture like 65% of all the money, 55% of all the money. And on top of that, if you slice it even further to kind of enter my next question is, most of this went to financial technology company. So how inclusive, how distributed from a geographical perspective, from a sector perspective? And I'd like to maybe pass the question to Nichole. Like, you're invested in companies that are not necessarily fintechs per se, And what is that is getting you excited about the non-fintech space as opposed to the fintech space? And what is, do you think, what are some of the drivers of the fintech hype that we've seen in the last few years?
Personally, I'm just bored with my fintechs. So there's almost, Barbara has new problems to solve in like the DeFi space, but fundamentally that for me, tackling non-fintech, there's things you can layer on with embedded finance, right?
Yes.
So for me, that's a much more exciting way to play in fintech. So if you take Helium, for example, yes, you're digitizing healthcare records, doing all of those things, but there's, $4 billion plus a year healthcare gap. So can they do lending based off of that to be able to pay for things? Can they, process your payments at the hospital? Like, there's ways to be able to layer that in. Sabi, which is another one of my, companies, you start with, digitizing like informal trade, but that involves money, right? You have to be able to pay for that. You have to be able to process that. So there's ways to layer in. So for me, the non-traditional, just pure like payments, et cetera, there's a lot you can layer on there. But what that shows is going to answer your question is every company, I can't remember whose quote it was, but every company becomes a fintech. So
I think that's Barbara's quote.
yeah, so it's like, literally, so it's like everything becomes a fintech. So fundamentally, that is why you end up kind of jumping to that, right? But I think there's so many opportunities for the pure play fintechs to plug into a bunch of the others, right? So it makes sense. Money has to exchange hands for it to be a business, and therefore fintech rules.
I'm glad you mentioned embedded finance straight away, because I was going to say, like, a lot of the drivers of the new generation of fintechs are actually the companies that are embedding financial technology products into their suite. Like you say, I'm digitizing teleconsultation, meh. But I also get payments for the reception of the hospital. You're like, here's $10 million, right? and this is something that there was seen a lot. Why? And here maybe again a bit controversial, but does that mean that the unit economics across Africa, beyond financial technology products, are still complicated for a number of reasons, that being, early access or a barrier to entry, or infrastructure that is needed, or regulation? What do you think is the opportunity beyond the embedded finance? When you cut that out, what is left of the economic opportunity to sort of go beyond the main products?
I'll just say, if I go down the path of still on Helium, for example, right? It's still education piece. Like, healthcare data is some of the most valuable in the world, but yet people don't want to pay for that on the continent yet. There's still a whole education piece, right, that has to be there. So when we're looking at stuff like during COVID, why were Africans not as affected? There's so much research and work that could have been done from like a genetic makeup, from all, but people don't want to pay for that. Fundamentally, it is extremely valuable. But if your audience, if you were trying to sell to, are not willing to pay for it, you have to find other ways essentially to supplement that, right? And keep your business growing so that way you can do that. So Helium had to say, okay, we need all of these hospitals and all of these patients. We will essentially give you this technology for free as long as I can process your payments and I can lend to you. So I'll give you those other components while I'm collecting this thing that I know is valuable, but you just don't appreciate at the moment, right? Sabi can go and say, I'm actually helping your business better, like be better. I'm doing all of this for you, but no one cares if you're not immediately giving them that money at that point. So you as a business can only do so much in that piece until it gets to kind of that critical stage, right? So I don't think the businesses there are not fundamentally valuable. I think the market just has to kind of catch up to what that is.
Yeah, so we're saying purchasing power of the consumer, or just behavior, that the consumer is not there, cultural factors. I wonder if we move a bit the conversation towards what the bottlenecks are in the investment space. Looking maybe at Europe, who are invested also beyond fintech. What do you see like as the bottleneck right now? And some of the questions, especially here, there's US investor, maybe some of you are new in the space, you want to get acquainted with some of the hurdles of the job. What could scare or what does scare investors away?
Yeah, well, I think firstly, we've been using two pretty broadly defined terms, one being fintech and the other being embedded. You know, and depending on how wide you want to go with that, you could be describing pretty much everything on the continent. I think to narrow it down, a core thesis for us, you know, with our first fund was that there's a lot of digital infrastructure to be built to serve the last mile. And it looks very different to, you know, single product fintechs that hyperscale in the US, for example. Again and again, we see this, you know, talking about bottlenecks, we see this sort of fintech journey of being able to unlock, say, you know, $1 to $2 million of revenue pretty quickly, scaling that up to 5 with some predominantly other fintech partners. But then really to truly scale the business, one looks around at, you know, as a fintech company and realize that there are bottlenecks in distribution, obviously, for traditional financial services operators that, with the right products, are partners. We've leaned into that quite heavily, where I think there are very uniquely African fintech products that have sold for the last mile. Going back to bottlenecks, I think one of the things that you know, we sort of wake up and remember every day is that, yes, the opportunity is massive, but, and I think Stephen Deng is here somewhere, the research is attributed to him that there are right now only, say, 40 million people that spend more than $10 a day on the continent. And when we look at bottlenecks, we look at, you know, unpacking wallet share, disposable income. Something that we've invested in that I wouldn't call a fintech, but if you want to use a really broad definition, is a business called Cocoa Networks that solves the, you know, in the US, unsexy problem of cooking fuel, which, you know, is a $20 billion per annum industry. And why we landed on that is really at the dynamics of, you know, hyperlocal commerce, shopping 4 or 5 times a week, spending less than $3 on average, you know, per basket. And then there've been various other iterations on, you know, on that theme between, you know, Sokowatch or Sabi. I think this year we're seeing a lot more attention from US investors on those uniquely particular African bottlenecks, specifically in social commerce and sort of logistics distribution meet fintech.
Thanks, Rob. So bottlenecks, obstacles, problems or questions that are raised by investors who are entering the space, especially in US and US investors or overseas investors. We have 3 women fund managers in here, and I think today I stumbled upon a couple of people in private equity space, a couple of family funds, family offices, and it'd be interesting to hear from your experiences. Maybe Eunice, you can. We were just discussing last night randomly before we knew you'd end up in the panel, right? How a fund can sort of make its name in the space, new funds and new fund managers. What has been your experience in terms of questions that have been asked, or like skepticism around you as a fund manager and the journey of getting someone else's money for your own initiative?
Yeah, definitely. I think it has been an interesting experience raising a fund to invest on the continent, for sure. I don't know about y'all's experience, but I think I've heard good, you know, like good things, and I've also heard, you know, like people that are still a little bit skeptical about the market. And I would say the big one is the African market is still very early in terms of merger and acquisition, as well as IPO, and what are the biggest way most investors in the US make their money, right? When there's an exit from a merger and acquisition or an IPO, and we've only seen a few on the continent. So a lot of them is always like, I understand you're investing early, but like, what is the exit strategy? And to appease their mind, I always say, like, as of right now, I understand that there's still there's a big gap in terms of, M&As and IPOs, but there's a large number of growth stage investors coming on the continent, and it's an opportunity for us early stage investors to potentially, exit during secondary. So that has been a good way to, like, appease their concerns. I would say the other one is just like risk management. Like, what are some of the risk investing on the continent, especially that I'm based in the US? Like, what does DD looks like in terms of financials, in terms of team, in terms of culture? We've seen from some of the recent media coverages that, like, company culture is super important. It can break or make your company. But on the other end, it's just, I think a lot of people are excited about emerging markets right now, and they understand that post-COVID, it doesn't matter where you're based. You could be in Africa, you could be in Latin, you could be in Mexico, it doesn't matter, right? And you can still build an amazing company. And I think a lot of investors are actually looking at emerging market strategy, Africa being one of them.
Thank you. I'd love to also hear Barbara's opinions.
Yeah, my experience, just to add on that, because she sort of captured it all, I'm focused on Web3 and DeFi as well. And I think that is a silver lining for me and for the ecosystem. Because I think if you think about what some of the bottlenecks have been around Africa VC, crypto is actually sort of the thing a lot of people understand. And they realize that Africa is this fertile ground for these economies to leapfrog into using digital currencies, because fundamentally the digital currencies, the future of digital currency is really in Africa. 54 countries not talking to each other. There's so much friction. There's a lot of inflation and a lot of devaluation. It's like digital currency is like sort of the holy grail for that. So that's what people think when they think about crypto and Africa. And so that has been helpful to me, because they're on this level, and I'm like, still on this level, because I know that there's so much to do in Africa to get us to that point, but because they're on this level, we can sort of drum up that excitement. So for me, I've been focused on companies that sort of intersection of TradFi and DeFi, because I know that you can't sort of just go into crypto completely. You have to bridge the gap. And you have to bring the traditional economy into the crypto space, DeFi space. And I sort of put that in front of the investors and say, look, this is the plan for Africa. It's not about this crypto bubble that we have in the US. It's more about permeating crypto in the traditional economy, and it becomes embedded in the economy. So that has been really helpful in helping me get people over the line on the Africa opportunity.
So relatability, risk management, some of the questions. Do you have a question, please?
Yes, I'll pass it to you. So this is a very interesting discussion. Thanks to all of you. I'm curious if we could go from each one of you, because each one of you is in a little different space, in a little different stage as investors or as a VC. Can you explain where you're getting your LPs one by one?
Look, I don't know if you've read my script, but this was literally my next way. So thank you.
I did read your script. It was left out in the lobby. No, I'm joking.
Thank you. Actually, so
no, it's a great question, because I mean the reality is we're all talking about funding and investing.
Yeah.
But it's so simple to talk about it. But the real challenge is, where are you getting the LPs? That's the real issue.
Yeah.
And that needs to be talked about at this summit, because there's a lot of funds. I'm a VC fund too, and there's a lot of issues on the table that needs to be talked about as to where are these LPs coming from, because the difference between a seed stage and a Series A investor is huge.
thank you. What's your name, sorry?
Daniel Ryan, Equatorius Capital.
Thank you, Daniel. So this came up as a conversation last night, and we wanted to make sure we discuss this, because going back to the opportunity, right? There's 3% of the companies that are actually making the big rounds in Africa, and If you look at these, Briter came up with some data around the fact that companies that have at least one local co-founder have raised 25% of total funding in 10 years. And on top of that, and on top of this, we have, I think, the tiny majority of the funding coming from local funds who have been raising from local funds. So a lot of the money is coming from development money, who is shifting in terms of kind of mental paradigm towards innovation and SMEs and sustainable models. And then the other is US and UK and Chinese funds and UAE funds, right? So the question now is, yes, where does the money come from? Is it private? Is it development money? Is it a mix of both? And do you see more appetite from overseas investors or from the continent? And as a kind of phase two of this question, what is your perception when it comes to talking to local LPs on the continent, and why are they keen on investing, or are they skeptical, or what are the conversations really? Maybe Rob, you can start from you.
Yeah, sure. I think we touched on this a little bit last night as well, and I think let's talk about where we want to get to. What would be a great outcome? If you look back at other fast-growing markets that have developed with local investor ecosystems, there's this kind of imperfect but similar pattern between like Brazil around 2008, 2010, whether it was hedge funds or then VC funds, Eastern Europe a little bit later around 2012, a little bit of increasing pension fund local liquidity in Kenya and Ghana in particular come to mind more recently. I think that's the biggest opportunity that's being missed, is for local capital to match assets and liabilities in market with these really talented, market-specific local funds that are being formulated. But we all know that takes long. It doesn't happen that quickly. Speaking, specifically about us, we were fortunate to, receive the backing of a number of family offices to get started. To prove out that we could be the bridge between this incredible opportunity that is the tech ecosystems of the continent and other emerging markets. And increasingly we're seeing that expansion. We've seen a number of African countries expanding to Mexico, Colombia, the Philippines. It is all getting a lot more global. What's encouraging, I think, as we sort of go out and raise our second fund, is the interest from corporates that are realizing that buying growth is a lot more efficient than opening up in market and trying to pull together a team and a product. And so I'm personally really excited about that. To specifically answer the question, I think we should all do everything we can to make it possible for corporate venture capital to find its way into the market increasingly. That's also where the exits are going to come from. And so that sort of just completes the life cycle of what we all do.
Yeah, I would add to that. For me, it's been corporates and family offices.
In the continent or outside the continent?
Both.
Okay.
Yeah, so corporates on ground, they want access to innovation. They want to, some banks are invested in funds. A conglomerate invested in one of the things I was doing. So I think conglomerates, corporates on ground and outside of Africa. In the crypto world, there's a ton of protocols and exchange platforms that are investing because they want to expand. You can create a nice protocol, but if no one's building on your protocol in Africa, then you're never going to see that Africa growth. And so to do that, they have to do multiple things: invest in startups, invest in funds. So there's a lot of that happening. And then family offices, just naturally, they take a lot of risk. But I think that the rubber meets the road really with LPs when you want to set up like a $100 million fund or a $200 million fund. Then you have to go to institutional funds. You have to go to the endowments, the pension funds. And that's a whole conversation in itself because, a lot of them, the question is, do they have an Africa mandate? Do they want to invest in Africa? Do they, do they look at Africa and the lack of exits as a issue in making that decision? You know, I've had conversations with people where they're like, when, you know, Sequoia or Anderson Horowitz doesn't exit, we'll look at Africa. You know, it's like really, you know, so there's a lot of work to be done on that level of institutional capital, but I think for really building this ecosystem in local managers, there's a lot of money in the corporates, with the family offices, and with other VCs. So I'm also seeing a lot of VCs, both in PE firms, by the way, they're all going into venture, and they are realizing that these early stage funds have a lot of deal flow, and they want to participate by investing in their funds. So that's also a big angle as well.
I think for me it's a little bit different. 90% of my fund right now is high net worth individuals. Like I have a lot of them. But it's also because this was my first fund, and it just took people in my network and my community to believe in me and say, yeah, like, you know, we're going to be writing, you know, like small checks, anything between $25,000 to $250,000. And, you know, like, you know, it accumulates. But yeah, like, and I have a few family offices and fund of funds, but those are like long lives, like those are long cycles. Like it takes a few months to close those. High net worths in a space, like they speak to you for 30 minutes and they're like, yeah, send me the link. And it's just
you
a
can
little
send
bit
it to all of us.
Yeah. It's a little bit of it's a quicker close, and it's a lot of people that just believe in the market. You know, it's either that.
Question, high net worths in Africa? Because
the
we all know who the high net worths are in Africa. Are they investing in funds?
No, in the US. There's a lot of, Americans just, who have been LPs in a lot of US funds, and they are looking to diversify their portfolios in emerging markets. Again, Africa being one of them, and are very open to, but I've actually had a very hard time getting my African brothers and sisters to invest in my fund. I have a few, but it's nothing compared to Americans just, yeah.
I went my weird path, which I always do. So I invest 100% off my own balance sheet for Chrysalis Capital. So my entire thesis in my life is to make sure I make millions of dollars on my advisory business so I can invest millions of dollars on the capital business. So that's my core. But there are corporates and people who we do help manage their funds. So there's the Jacobs Foundation out of Switzerland. We help manage their education fund. There's a fund out of Canada that we help manage as well. And then we're helping a Nigerian oil and gas company actually start their new fund. So that'll be out soon. So we're doing everything for it. So I will gladly help you start your fund, set it up, run it, manage it, do all of that. But you will not be my LP because I answer to no one. So.
Daniel, I hope this also answers some of your questions.
Thank you very much. That was very helpful.
Please.
All right. Thank you so much. It's been a very interesting panel. I'm curious to hear your thoughts around valuations in Africa, and then what valuations multiples are you seeing, especially within the fintech space? And then lastly, it's this whole concept of large, several funds chasing a few deals on the continent. What's your perspective around this also?
You just dropped two easy questions. Thanks. Who wants to pick this up?
I'm looking at Nichole on the valuation.
Oh. I mean, I think it's so relative, right? Like, you could say, oh, okay, well, this company, somebody did, 20x a rev multiple. Somebody's using EBITDA. Someone's using a per customer. Can argue whether that should be registered or active. You can do all kinds of different things. But for me, what really should matter is when you drill down into the company, looking at their cohorts, looking at what people are actually, how people feel about that brand and what you actually think you can get for that future. I remember I had this, Rob, do you remember years ago, you're like, Nichole, I hate DCF. He hates, it always sticks with me. I laugh at it every time I think about it. But Rob is like, yes, sure, this big green future, you can always predict that. But being able to show that clear path, right? So you can argue if a company's over or undervalued, but when I'm looking at any of my companies, I'm like, can we actually sustain this, right? Because you honestly do yourself a disservice sometimes if you go and say, I'm going to get this really big number, but then you can't measure up. You can't. So what is the point, right? Were you raising for the right partners and you know exactly what you're going to use that capital for and actually be able to return it? Or are you raising for that TechCrunch article? Because those are two very different things. And I mean, that's fine. You can optimize for one or the other, but just be honest with yourself, right, about what you're optimizing for. I do think that there's things you can look at as what is fair, because you're not going to get the multiples of what the US companies are going to get. That's just a fact. Your people have less disposable income. Your people have less infrastructure. Like, those are just facts. But I also think we need to not take so much of that whole like Africa discount too. So I don't know. It's just, it depends to me really on what that company can actually do. And how their customers feel, and they can actually return, you know what I'm saying, like on that.
I have a feeling that in the last few months we've witnessed kind of like a setting aside of the Africa discount in favor of absolute crazy FOMO. There's been, if you've actually been monitoring the space, every country has the same set of companies across the same set of products that raise funding. So there's every country or every region or sub-region has a neobank or two. Every sub-region has a 2-3 commercial or non-commercial solar developer. Then there's a B2B commerce. There's 2 in Egypt, 2 in Kenya, 2 in Nigeria, and then there's that one that does it in Francophone Africa. So there's the B2B commerce for Francophone Africa, right? And everyone is just like jacking money into this. So I don't know if this is a phase. What I feel comfortable agreeing on is the fact that, as Nichole is saying, she's investing on balance sheet. She's not the only one. Goldman Sachs has just spun out a fund, Juven, and they're investing on balance sheet and not. Goldman were investing in balance sheet. Briter is seeing dozens of corporates and private equity firms coming towards us to give them market insights to set up funds that are non-bound to, like not time-bound. So there's not that 5, 7, 10 years, but they just invest long-term. So what I feel comfortable, and I love to hear what you think, there's an increase in the type of capital that is being made available on the continent. So there's corporates investing long-term. There's VC. You mentioned small tickets. The new generation of funds is, I don't know if any of you, I know some of you in the audience do run this, but the rolling funds, right, or the syndicates. These are the new generation of early stage funding, right? Or rev share vehicles, or funds of funds such as kind of CDC that now is setting up a whole venture capital space. Like venture, I used to work for CDC. Like 5 years ago was a blasphemy, venture, but it was just via venture capital at CDC, right? And now it becomes a reality. So I think it takes time, much to convince customers, to convince LPs. It takes time, but the diversity that we're seeing in the increase in the type of vehicles that are being set up is very promising. Please.
Yeah, just a quick follow-up, because you're hitting a key element. USA, the old DFID, a lot of these entities are now looking at, rather than just donations, investments.
Yeah.
And that's becoming a big part of the VC play throughout Africa. That's a good thing.
100%. So CDC, ProParco, DFC, FMO, GIZ, KDFW, JICA, they're all invested now in.
You just listed a number of players that can help these folks.
Not really.
That's a question. Funds prefer commercial.
Yeah.
Yeah.
They're slow.
To some extent,
slow.
yeah, it's a very controversial conversation, which.
Yeah, so what's driving this ecosystem is definitely not the DFIs, that's for sure. All of this that we've just been talking about, all this new capital is coming from the private sector. It's corporates, it's VCs, the reason why we're talking about valuations is like we're all investors here, but the reality is being an investor right now is just not the cool thing anymore. It's a founder's market. Being a founder is the cool thing because all of this capital is driving these founders to get better terms from more people. And so that is going to mean higher valuations. And that is just a consequence of this market, and it's a global issue. This is not just an Africa thing. So the DFIs are actually not participating in that. They're the worst, type of investor from the perspective of, putting out such favorable terms to founders. They're a lot more stringent. They want to make sure that there's an impact and all of that. But a lot of founders, to Nichole's point, a lot of founders are out there and they want the best deals and they don't want these stringent terms, they want higher valuations, and the DFIs aren't giving that to them.
But
So
I
that's
think
what's happening.
if you look kind of like through the cycle, what's happened in the last 12 months is that pick a bulge bracket well-known US VC fund, and they've had their first foray into Africa, operating in the same way that they do in the US. And we'll see how that plays out, because the same playbook, I would argue, won't necessarily work in our markets when it comes to bringing scale. One thing that always excites me about the African VC ecosystem, which I think is quite unique, and you see a little bit in global climate tech investing and in the DeFi space too, is that there are not that many sharp elbows. I know that if I set foot in Lagos and these two don't know about it, I'm going to be in a lot of trouble. There's a lot of work to be done across stages, but if you just put some kind of numbers to it, I think in the last 3 years, we try and map this as accurate as possible, and I think we've looked at a little over $3 billion of deal value, and it used to be that 50% of that was at Series A, and it's now 80% pre-A, which is reflective of the US as well, where bulge bracket US venture has a mandate to be writing 50% pre-Series A. That's where the sort of valuation inflations come through. What is an exercise that I find very refreshing as we build out, the African fintech venture community, is talking through the probabilities of growing from pre-seed, seed through A, what it's going to take to achieve scale.
Yes.
And I think the most appreciated virtue in VC founder relations is, an acute self-awareness, but from both sides of the table. As a VC, what can you bring and when can you get out the way? And as a founder, what can you do and what do you need help with? And I think we're getting there, which is when you have a valuation conversation at the end, when that box is checked. I don't think we should jump to conclusions that African fintech generally is grossly over or undervalued or fairly valued at all.
And I just want to mention something to Barbara's point. At the end of the day, what is really valuation? It's like what investors are willing to pay, right? And if you're putting your valuation, you're raising a $3 million at a $35 million valuation. If investors are willing to invest, then that's, there's nothing you can do about it. That's just the way it is. And if you're also valuing yourself low and investors are willing to take that, again.
I think to this point, so one of the measures to come up with valuation is comparables, right? So what happens when a market is inflated is that comparables are, by definition, inflated. And so your valuation from today becomes like, I've had a conversation where I'd be like, I think Briter is valued, I don't know, $1 million. And people be like, you're crazy. It's at least 10. And I'm like, what do you mean? You say, are you not seeing all these rounds? So this is the conversation that is happening. I think it's very non-technical and non-scientific. And I think VCs that care about structure and rigor don't fall for this. But there are a lot of people with lots of money that are entering the space that have cheap money. And I've happened, I don't invest, but I've happened to speak to funds on the ground that have told me cheap money coming from the States is actually crowding us out to the point that they have to revise their investment thesis to later or earlier stages to try to kind of compensate
They shouldn't be so cheap then.
No, but not them.
The local investors shouldn't be so horrible.
Sure.
They come and then they tell a company founder, I'm going to give you, I mean, if you go back in Nigeria 5-6 years, not even that long, I'm going to give you $500,000 for 50% of your, like, come on.
Fair.
So,
Yeah,
I'm sorry, like, it's a balance. There is a balance between those two. So local, I'm saying all of our corporate, et cetera, keep saying, oh, it's too high, it's too high. I'm like, what does that mean? Right? Like, founders are working in their business day in, day out too. Like, unless you're going to say, I'm directly helping you with your license, or I'm directly helping you with these things, like, you can show that. But historically, and this is not just an Africa thing, it happened in Europe as well, and so a lot of shift, like, where local is significantly undervaluing, right? So international may be overvaluing, locals undervaluing, so where do we find that sweet spot? You don't get to complain if you are part of the first problem that they are overcorrecting for, right?
Yeah, and let's be honest. There's also a racial thing, because if you are or an expat thing. If you're an expat building a business in Africa, you can sit down with some investors and command a high valuation. But if you're not, and you're a local founder, and you're doing the same business in Africa, people expect a lower valuation. So that has all been changed in the last couple of years, because because it's a founder's market and there's just a lot more money.
As well as the YC bump, which none of us has mentioned, but it's real.
And then there's a YC bump. So there's all of that. But one thing I will say is, when founders do want really crazy valuations based on their fundamentals, I always say you're also doing them a disservice, because you don't want to spend the rest of your 12 months living up to your valuation. You want to build your business in peace. And so that also is a problem. So there has to be a balance.
And I just want to add to that. Sometimes I ask myself, I don't know if, like, founders are actually educated how investors think about valuation, right? Because on my end, for example, there's a cap at which if you're raising beyond that, I mean, you just become too expensive for me. So when you're a pre-seed and you're valuing yourself at a $20 million, you're raising $1 million at a $20 million valuation. I'm like, you're pre-seed, but also, like, I mean, I can't invest in you because you're just too expensive.
But that's okay, right?
Exactly, and every single time I'm like, great for you, right? I'm sure there are investors out there that will be willing to invest in you. I just wouldn't be willing to take that bet.
And that's what I'm saying, and that's perfectly fine, right? And I think when, all the companies that I'm working with, that I'm invested in, I'm like, I don't like the general term roadshow. Like, everybody knows me, I'm like, we're speaking to a certain number of people that I know fit you. Like, either their stage, personality, the culture between your two, like, the whole point of this is it's dating, it's this long marriage. Like, it's not every single person that's gonna be aligned. So the part that does get in that same thing where it's like, oh, well, we have an early stage fund and we have, this stage fund. You're too big for our early stage, but it's too small for our growth. So, maybe raise less and shrink. Like, that's not really my problem, right? Like, we just aren't a fit.
Yeah.
And so I think, everybody viewing it from that way, like, it is what it is. It's what there's somebody that fits you if you know that you're raising again on fundamentals, not just like, oh, well, they raised at this, so I should, nah.
Or that's where the healthy conversation of showing me how we're going to get there happens, and then sort of like running through the probability weighted scenarios of getting to a certain space in a certain market over time, and backing that back out to the fact that we do have two customers, we have founders and we have investors, and we underwrite to a 10x. So if we can get there together reasonably, that's when we can back out to valuation.
I think there's a conversation to be had, and a reality check is when a Tiger Global enters the market with $300 million invested in companies, and that represents like 0.7% of their asset under management, and then you have funds who need to like basically give out their soul to enter deals. That I don't want to say it's good, I don't want to say it's bad. We don't have yet the data to say whether that will have been a bad or a good element as an impact on the ecosystem. But I think it's a conversation to be had, because there's the need for the local investors to have conversation and to enter in co-investment with funds that come in with different atmospheres beyond these local funds in terms of.
But that's why you can't compare yourself with Tiger Global.
Sure.
So that's why I say all the time, just because Tiger Global invested in this deal doesn't mean I'm going to invest in this deal. Tiger Global can afford to lose $300 million.
Yeah.
But
I can't.
But what he was saying was a lot of investors are crowding. We have to go.
Yeah.
Yes. A lot of investors are running after the same pool of companies, right?
Yeah.
Like the companies are those. As someone said today, the ecosystem is small. It's growing. There are amazing factors that are showing the growth of the ecosystem, but it's very small. And lots of new funds are entering with different war chests, the ecosystem, and they're creating shocks. I think this is probably even a good way to end the conversation, as in is it good or bad? We don't have the information yet. We'll probably know in 5 to 10 years when the life cycle of this fund will end. But maybe we can have a final word in terms of perception that we have when it comes to where this new year will lead, or also based on your experience and your fund experience.
Yeah, I mean, I think this year is exciting. I think what it will shake out are companies that are fundamentally strong, and you'll see those continue to do really well. There's still a bunch of new ideas. What I don't like is just like, oh, I have an idea, I need money, versus money is not your problem. Like, build your actual business. Money is a tool, not the answer. But I think fundamentally strong businesses will actually win, and as long as they just stay focused. Yeah.
I'm excited. I think Africa is up to something, and the world is paying attention, and we're just getting started.
Yeah, I think as an investor, all these challenges, I look at them as an opportunity for me as an investor to make sure that I have a thesis, I'm doing things properly, I'm disciplined, like literally everything you went to school, and I'm not being a FOMO investor, and I'm not just trying to do this because everyone's doing it. I think it forces me to fundamentally think about what type of ecosystem I'm trying to build here, because we have the power to build the right ecosystem and back the right founder. So I'm excited about being creative and demonstrating that through my portfolio.
I just think the scale effects are so much easier now. We have had a lot of success bringing in successful founders in the US or Europe as small investors and advisors to our portfolio, and to see the interaction between founders in different markets with similar but different dynamics is like watching magic happen. So I'm excited about that, and I think we just stay curious and humble and keep building and not pay too much attention to every news article we'll get there.
Thank you, everyone. So just to end on this note, this is a business conference, so these investors are at the very least investing. So founders come forward, LPs or potential LPs, conversations and co-investors. Please have a look at these names and get in touch. Thank you, everyone, and we can take questions outside if you want.
Thank you.
Thank you so much. Thank you. Thanks, Barbara. Thanks. Thank you. Thanks, Dario. What a great panel. Okay, so for the next two panels, if you want to attend the cryptocurrency redefining the meaning of money, please make your way to the breakout room. This panel is facilitated by Permi Kitema, partner at McKinsey, and the speakers are Ray Youssef, co-founder and CEO of Paxful, Christian Duffus, founder and CEO of Fundbank, Obi Emetaram, founder and CEO of AppZone, and Chris Morris, CEO and co-founder of Yellow Card Financial. So this is also a great panel for you happening in the breakout room. For those of you staying here, we'll talk about diaspora banking and remittances. So this is a topic that's so close to my heart. I'm